Good afternoon, Dan. It's now 2 o'clock. If you'd like to start.
Okay, thanks, Selfie. Welcome everyone to this Carson International Miller Thomson session on non-resident importers tips and traps. This is one in a series of sessions that we're having on hot topics within Canada's customs and trade regime. My name is Dan Kisselback. I'm a partner with Miller Thomson, and with me is Dave Pentland. He's a vice president with Carson International. Together, we're going to have a little bit of a discussion about non-resident importers and deal with what we see as the hot areas of concern. Dave has been in this business for many, many years, more than probably you want to remember, right, Dave?
That's correct. Yeah.
And me too. I've been practicing for about 30 years in the area of international trade and customs. So here we are in an era where e-commerce is king. Growth in the area of e-commerce is like a hockey stick. And we see many, many companies that are getting involved in the area of e-commerce and entering into new markets such as Canada as non-residents. I guess you see that quite a bit, right, Dave?
Yeah, more and more. It's a very hot topic, and the big issue is trying to stay outside of CBSA. So that's what it's all about today.
So the advantages are that you don't have to get involved in Canada's legal regime, other than you have to comply with the duties and taxes and so forth. But you don't have to set up a bricks and mortar enterprise necessarily. But the disadvantages is that there could be minefields for the unwary. So we're going to try to deal with that. Every year there's a new, fresh crop, I guess, of importers that just don't do the planning in advance, and then they get sometimes tripped up when they're under audit and verification. So planning, if you take anything out of this, planning is an excellent idea, because you don't want to be trying to catch up after the Canada Border Services issues a verification or audit letter to you. On to the next slide. So what do the officers look for? They're looking for, what is the sale for export that causes the goods to go into the country, into Canada? And so in order to use the transaction value method, which is the primary method for valuation, you have to have a sale for export to a purchaser in Canada. And that's the name of the game in this discussion. Non-residents can become a purchaser in Canada. So you can have a sale for export, which is your lower foreign supply costs, and have those goods reported to Canada Customs, and you can be a purchaser in Canada, even though you as a non-resident aren't really incorporated in Canada and you don't have mind and management in Canada. On to the next slide. So goods are levied, duty on goods is levied on the value for duty. So it's worthwhile to try to make sure that the value is lower than it otherwise could be. You don't want to overpay duty. And there's 5 different methods. And the one that we're going to talk about primarily here is the transaction value method. If it doesn't fit within the transaction method, then you have to go into the alternative methods, which may be the deductive method or the computed method. Basically, you're trying to figure out what are the costs of the goods on the basis of statutory provisions. On to the next one. So, as we mentioned, there has to be a sale for export to Canada, and the goods have to be sold to a purchaser in Canada. And the price paid or payable must be, you must be able to determine that. Usually that's not a big issue because you've got an invoice or a sale. On to the next one. So a sale is a transfer of ownership or title to the goods from one person to another. And sale is interpreted in the widest possible sense, including an agreement for sale. So if you have a contractual arrangement of any type, that's going to be considered as a sale by the CBSA, and that's important for reasons I'll get into in a minute. Naming a person as the importer doesn't affect the determination as to whether or not a sale has occurred or which sale to use for valuation purposes. And Mattel is a Supreme Court of Canada case that says that the importer is the person who owns the goods, who has title to the goods at the time of importation. On to the next slide. Moving right along. I guess we got hung up here. There we go. So as I mentioned, you have to have a sale for export to a purchaser in Canada. Who's a purchaser in Canada? Well, it's a definition. There's in certain regulations of value for duty regulations. A purchaser in Canada can be a resident, which we're not. In this case, we're not talking about residents. Or a person who is not a resident, but who has a permanent establishment. And what is a permanent establishment? A permanent establishment is a fixed place of business through which a person carries on business. So it doesn't, you know, mind and management of that fixed place of business could be in the United States or somewhere else. A purchaser in Canada could be a person who imports goods, isn't a resident, doesn't have a permanent establishment, but they're using it, those goods for their own consumption or use, or as inventory, unsold inventory. And this is what we see quite a bit, right, David? Is folks are non-resident importers and they import unsold inventory, they store it in a warehouse, and then they make domestic sales. You report the lowest value, which is the foreign supply cost, rather than the domestic sale cost.
Yes, yeah, and this is where it usually gets hung up, where a non-resident hires a 3PL in Canada to perform those services, and this is where you need to do a little bit of homework to ensure that CBSA understands the relationship of the 3PL with a non-resident importer and how goods are valued. So, yeah.
Right. On to the next slide, please. So here again, a resident is a person who ordinarily resides in Canada or a corporation that carries on business and of which mind and management is in management and control is in Canada. We're not talking about residents, we're talking about non-residents. On to the next slide. Okay. I think we're having a little trouble with we're having a bit of technical difficulties here. There we go. Okay, so again, what is a permanent establishment? Because as I mentioned, you can have a sale for export to a purchaser in Canada, and you can be a purchaser in Canada if you have a permanent establishment. A permanent establishment is a fixed place of business through which you carry on business. And that fixed place of business has to be a business that you control. You can't have multiple people controlling this thing. So it can be a branch, an office, a factory, a workshop, through which at least one employee or dependent agent carries on that business through that fixed place of business. And there's policies that deal with this thing. And there's a case, the Foster Grant case, that also provides some guidance on this matter. And what we see sometimes is people, you know, they'll have the fixed place of business, but they don't really have enough employees, or they don't have any employees, and then they get tripped up on the rules. So you've got to make sure that if you're going to have a permanent establishment, you've got to have a fixed place of business through which you carry on business through at least one or two employees. Yeah,
just one comment. I guess that the CBSA is really concerned about management and control, so that you have to have at least one officer or person at that facility that exercise and, you know, is involved in the finances of the company, but definitely has management control. It can't be just a sales agency. So,
on to the next slide, please. Person imports for their own consumption or use. So, you know, that doesn't happen so frequently for us. We're more concerned about commercial importers, but if you import for your own consumption or use, then you can be a purchaser in Canada, and then you can use the foreign supply cost because there will be a sale for export to a purchaser in Canada. On to the next slide. this is, you know, as inventory. This is the biggest one we see is folks get tripped up on the inventory rule. So you can import goods as inventory, unsold inventory, and in which case you can use the foreign supply cost as the sale for export that causes the goods to be imported to a purchaser in Canada, which is the non-resident, because the purchaser in Canada counts, the non-resident counts as a purchaser in Canada under 2.1c little II of the regulations. But you have to watch it, because what the CBSA is looking for are any documents that suggest that you've already sold the goods to your Canadian customers. If you're the non-resident, if you take purchase orders, then go buy the goods and then import them, you're going to be stuck with declaring the higher Canadian customer costs, and you don't want to have that happen. Any comments, David?
No, just that it's customs takes a wide berth on that. So even when we have clients that don't take purchase orders, we always get in this wrestling match with CBSA on what's a prior agreement to sell. So, and I'll just pick on the garment industry. We often get into fights where people have bookings which are not a purchase order, and both parties can back out of it. And we've had to go over and over based on the years of experience of the CBS auditor to show that those bookings are in fact not a indication to purchase the goods. They're just an indication for the level of quantities, and then the non-resident importer has to determine what quantities they bring in. So it has to be speculative. So
I'd like to see you in a wrestling match with the CBSA. Actually, it'd be kind of fun.
Yeah, well, when it gets tough, I end up pulling you into the ring, so that's fine.
Okay. So the biggest thing is you've got to, I think, structure the sequence, have it in mind as to what's going on before you start doing the importation, because if you have a unrealized liability, it can pile up, especially if you have high volume imports or imports of high value goods. So what have we got here? A non-resident importer without a permanent establishment who does not meet the criteria set out in 2.1c, own consumption, will not be considered a purchaser in Canada. This is where you don't want to be. The result of not being a purchaser in Canada will likely be that you have to use the higher Canadian customer sale price as the basis for the valuation for duty. So you always invariably want to use the lower foreign supply costs rather than the higher Canadian customer costs, because the value for duty, the duty is levied on the value, and an increased value is going to result in higher duty. On to the next slide. So how does it all work? Here's scenario one: a non-resident importer, no permanent establishment in Canada, prior sales agreement. So consider this example of a non-resident importer who takes orders from Canadian customers prior to the importation, who has no permanent establishment in Canada. So a non-resident importer carries on business outside of Canada, does not have a permanent establishment in Canada. The non-resident receives purchase orders from its Canadian customers for the purchase and supply goods for, say, $100. The non-resident and the Canadian customers agree that the customers must accept delivery of the goods, and the payment of the goods will be made at the time of their delivery. The non-resident importer then makes an order with a third party contract manufacturer, say in China, to make the goods and deliver them to the Canadian customers at a cost of, say, $50, so half of the Canadian customer cost. The foreign contract manufacturer makes the goods for the non-resident importers. On to the next slide. Then what happens? The verification officer is likely to decide that there was a sale for export between the non-resident importer and the Canadian customer. The Canadian customer is the purchaser in Canada. The price paid or payable for the goods can be determined. It's the higher $100 customer price. This constitutes a sale for customs purposes, and the importer must base its value declaration on the transaction value. That is the price paid or payable by the Canadian customers. There was a second sale prior to the importation between the non-resident importer and the foreign contract manufacturer, the $50 price. Over onto the next. The non-resident importer cannot use the sale between the foreign contract manufacturer and the non-resident importer, like the $50 price. This is because the sale between the foreign contract manufacturer and the non-resident importer is not a sale to a purchaser in Canada. The non-resident is not a purchaser in Canada because it is not a resident in Canada. It doesn't have a permanent establishment in Canada, and it had a prior sale agreement before the goods were imported. So bad one, you don't want to do scenario one, right, David?
No, and this is the one that CBSA will always want to push non-resident importers into. So if you don't put up a good defense, you end up being pushed in that category, and it's one that we see over and over again. So,
okay, on to the next slide, scenario 2. Here, a non-resident importer with a permanent establishment in Canada and a prior sales agreement. Consider this example of a non-resident importer who takes orders from Canadian customers who has a permanent establishment in Canada. Non-resident importer carries on business outside of Canada and has a permanent establishment in Canada. That is a fixed place of business through which you carry on business. The non-resident importer receives purchase orders from its Canadian customers for the purchase and supply of goods, say for $100 through its permanent establishment. So that's the Canadian customer price. The non-resident importer and the Canadian customers agree that the customers must accept delivery of the goods and that payment for the goods will be made at their time of their delivery to the Canadian customers in Canada. On to the next slide, please. The non-resident importer then makes an order with a third-party contractor for $50. The foreign contract manufacturer makes the goods. The non-resident importer pays the contractor for the goods upon taking delivery of them at the production facility. The importer, a non-resident importer, owns the goods and assumes the risk of loss for them at the time of their importation. The non-resident importer supplies the goods to Canadian customers. On to the next slide. What's the result? The verification officer is likely to conclude that there was a sale for export between the non-resident importer and the foreign contract manufacturer. The non-resident importer should use the sale between the foreign contract manufacturer and the non-resident importer for customs purposes, the lower $50 price, as this is the international sale which results in the export of the goods and the importation of the goods into Canada. This is because the sale between the foreign contract manufacturer and the non-resident is a sale to a purchaser in Canada, as that term is defined in the valuation for duty regulations. A purchaser in Canada includes a entity that or person that has a permanent establishment, a fixed place of business through which you carry on business. On to the next one. Scenario 3. Well, I guess I've said all those things. Non-resident importer with no permanent establishment in Canada imports his inventory. So consider this example of a non-resident importer who does not take orders from Canadian customers prior to their importation, and who does not have a permanent establishment in Canada. The non-resident importer carries on business outside of Canada. Maybe it's in the United States, maybe it's in California. It doesn't have a permanent establishment in Canada. So no fixed place of business through which it carries on business in Canada. The non-resident importer, say in the United States and California, receives expressions of interest, some sort of forecast, some indication that the customers may be interested in certain types of goods, a statement indicating what it might be interested in buying, but has no purchase order or agreement for sale respecting the goods from its Canadian customers. The non-resident importer and the Canadian customers agree that the customers are entitled to refuse delivery of the goods, refuse to pay for the goods unless and until the Canadian customers accept delivery of them in Canada. The non-resident importer makes an order with third-party contract manufacturer for the goods for, say, $50. On to the next slide. The foreign contract manufacturer makes them, the non-resident importer imports them, and it owns the goods at the time of the importation, assumes risk of loss, and inventories the goods at the Canadian warehouse. Sometimes they'll insure them and everything else, and so it's booked as their own inventory at all material times when they're imported and placed in a warehouse. The non-resident importer supplies the goods to the Canadian customers. The Canadian customers then accept delivery of the goods and pay the non-resident importer in Canada. On to the next slide. Here, what is the result? A Canada Border Services Agency officer is likely to conclude that there was a sale for exporter export between the non-resident importer and the foreign contract manufacturer. The non-resident importer should use the sale between the foreign contract manufacturer and the non-resident importer for customs purposes. The lower $50 price, as this is the international sale, which results in the importation of the goods. This is because the sale of the foreign contract manufacturer and the non-resident is a sale to a purchaser in Canada. The non-resident is a purchaser in Canada because it imported the goods for sale in Canada and prior to the non-resident importer's purchase of the goods from a foreign contract manufacturer. The non-resident importer has not entered into an agreement to sell. So there was no prior agreement to sell. And so if you import goods as inventory on speculation of sale, there's no prior agreement for sale. You put them in the warehouse and then there is another sale. That is a domestic sale, doesn't count. On to the next slide. 4. Here we got a situation where a non-resident importer, a manufacturer imports inventory, just simply say a transfer from a US parent inventory, a warehouse, say in California and Los Angeles, to a warehouse in Kamloops, and it's stored there. Just replenishing inventory, not sold. What happens here? Non-resident importer manufactures the goods outside of Canada at, say, $50 each. The non-resident importer imports the goods into Canada. The non-resident importer places the goods into inventory on speculation of sale. The non-resident importer then supplies the goods to Canadian customers. On to the next slide. The CBSA officer is likely to conclude there was no sale for export because it just wasn't a sale. The non-resident importer can't use the transaction value method, so you got to go into the next, valuation methods. And in this situation, the non-resident importer should use some alternative method, maybe the deductive or computed value based upon the $50 cost in order to appraise the value for duty of the goods. So it's still the lower foreign supply cost.
Yeah.
Any comments?
I was just going to say before we move on, that inventory issue happens quite a bit where people actually in scenario 3 have it hammered down that they don't have an agreement for sale and bring goods in, and everything's on side with CBSA. However, they forget that quite often their 3PL may run out of goods and maybe have to move goods from their other 3PL in the United States or from their facility. And they just assume that because they're transferring between their facility in the United States to themselves in Canada, that they should be able to use the price as it sits on their books, and they can't. And so it's a common mistake by companies that, will be on side on scenario 3. However, scenario 4, they don't think about it. It's just that it's a cost of carrying on business where you have run out of inventory and you want to replenish it and can't wait for goods coming from overseas. So it gets in a little deeper where a lot of people end up using a different valuation process, and usually we get involved where it's on a computed valuation where you're giving the best cost or a best price scenario as if it was the best customer in Canada, but it involves a little bit of work and something that certainly needs to be set up in advance. So, yeah. On to GST, thrilling world of GST.
Yeah. And I just want to mention that if you have a problem or if you're planning to import as a non-resident importer, or you want to verify what you're doing, seek some legal advice, or, you decide what you want to do. This isn't legal advice, but it's important to get this hammered down, nailed down, so that you can move forward with confidence. The last thing you want to do is have an unexpected letter and then a tussle with the CBSA, maybe a wrestle with the CBSA. So on to GST, and we've got 6 minutes, so we won't spend a whole lot. But GST is another area, surprisingly, that folks get tripped up on. And I've had to do $1.3 billion voluntary disclosures for sophisticated oil companies that miss some of these tax points and stuff. So it's important to just remember the biggest thing, the biggest takeaway is that there's 2 tax points in the GST under the Excise Tax Act. One is import GST. Excise Tax Act Division 3. You got to declare the goods pay GST at the time of importation. Somebody does. And then there's domestic supply GST. That is a separate deal. You have to, if you're making a sale, collect GST under Division 2 of the Excise Tax Act on account of a taxable supply made in Canada, and you collect and remit that to the government. You're deputized by the government. If you don't do it, then you're potentially liable to pay the GST yourself. So those two things is the biggest thing that I see, is that people forget that there's actually two tax points. So here I say GST registrants charge, collect, and remit GST on taxable supplies, and generally you're out of you don't have to worry about it if you're a small supplier, you sell less than $30,000, something in that range. And the way it works is that if you pay GST in the course of a commercial activity, you can collect it back as an input tax credit if you're registered for GST purposes. So it's important to register. I think David, you've run into cases where people haven't registered and then they're out of the game. They've just got the GST is unrecoverable.
Yeah, and I think further on, I'm not sure you may get to all the GST slides, but there's a, and I'm going to pick on a little bit without being slandering them, but some of the express couriers will often obtain a business number, which is in fact the basis of your GST number for importers, and that GST number will not be registered, and in those cases you're paying GST coming in, but you're not entitled to claim it, and that's where people run afoul of the GST on the import side.
Yeah. So for goodness sakes, if you're going to import and you're going to pay GST, on this slide here, register with the CRA, get a business number. You got to get a customs account number and a GST number. And then if you've got that, you're registered for GST, then you can claim back an input tax credit if it's made in the course of commercial activity. And at the bottom it says that if you don't collect and remit as required, that is the Division 2, if you're selling, then you may be on the hook for it yourself. So the biggest point, again, there's two tax points. Here's one, GST tax point Division 2. That is on account of the domestic supply of GST. It's imposed when you make a taxable sale of a good or service in Canada. And that is one of the leading customs and tax audit issues incurred by non-resident importers. On to the next slide. Steps in determining when the GST should be imposed. Step 1, determine whether or not the supply is taxable. On to the next slide. 2, determine whether or not the supply was made in Canada, and there's some place of supply goods rules which deem the supply to be made in Canada if the goods are delivered or made available in Canada to the recipient. So you have to know these things. On to the next slide. Then there's more rules here. Determine whether or not the place of supply was made in Canada. In order to apply the place of supply rules, you must know the meaning of resident. And we talked about that. A resident is a corporation incorporated in Canada or a corporation that carries on business. And the CRA policy lists factors as to what is carrying on business. On to the next slide. So if you make a taxable supply in Canada and Division is Division 2 GST is considered, you have to consider the place of supply rules for HST. HST, for example, if the place of supply is in Ontario, you have to consider that. If it's BC, then you may have to think about PST. And in Alberta, there's no provincial sales tax. So you have to consider what is the ultimate place of supply. Now, the second tax point I want to mention is Division 3, import GST. And import GST is paid and collected as if it were a customs duty. So you report the goods on your B3 Canada Customs Coding form, and you have a customs duty amount and a GST amount. On to the next slide. a non-resident importer who doesn't have, this is the summary. So basically, if a non-resident importer who does not have a permanent establishment in Canada can import goods as inventory and declare the value for goods based upon their supply costs. We talked about that. A non-resident importer who has a permanent establishment in Canada, an office, workshop, etc., through which it carries on business, may both order from Canadian customers and purchase goods from their foreign manufacturer and declare the value based upon their supply costs. In both situations, the non-resident importer may qualify as a purchaser in Canada and use the transaction value under Section 48 of the Customs Act and take advantage of the lower supply price. On to the next slide. GST, it's important to know whether the non-resident importer is registered, because you can unlock paid GST and recover it back as an input tax credit. And where a non-resident importer contracts to supply goods outside of Canada, it's best to arrange for the recipient to import the goods, pay the Division 3 import GST, and claim an input tax credit. That is because if you're, say, a Good Samaritan and you import the goods and you're not registered for GST and you pay the GST, then you might not be able to claim back. You probably won't be able to claim back the GST as an input tax credit. So it's best to make sure that, that if you're the non-resident importer, the easiest thing to do is often importing the goods, being registered for GST purposes, and then you can claim back the input tax credit from the Government of Canada. On to the next. Yeah, so that's the point that I made here, is that it's best to be registered and have the place of supply in Canada so that you can claim back all the GST. And we're 1 minute over, so on to the next slide. Any comments, David?
Yeah, I guess just on the GST to kind of recap it is the GST is really supposed to be a flow-through tax that's not supposed to impact businesses at all. So unfortunately, it employs probably 100,000 accountants in Canada, but it's not supposed to be a cost. So that's the biggest thing that non-resident importers need to understand is, as long as you're registered for GST, all your imports that you pay GST, you can recover by then invoicing your clients, and also fees, like indicated in the last slide, for services rendered in Canada, where a 3PL has to charge GST, or the brokerage services, we have to put GST on our services. Same with attorney's fees, they have to put GST. Those are all recoverable expenses. Same thing pre-COVID, where people actually would visit Canada from the United States, and if they pay GST on their hotel bills, they can recover all that GST once you're registered. So the biggest takeaway on the GST from a broker's perspective is that it's beholden upon you to actually take a look to make sure you're registered for GST. If you're not, you need to take steps to register very quickly. And also in Canada, you know, if I look at our payables department within our company, we're not allowed to pay a company unless we verify that their GST number is registered. So, because if we had a tax audit and we actually paid GST to somebody who was not registered, we'd have to pay back the federal government. So that's kind of my wrap up on the GST side of things.
Good stuff. Well, I want to thank everyone for participating in this call. It's always a joy and a pleasure to talk to you, David. I guess we're going to consider what our next session will be about. It may be involving the new retaliatory tariffs, potentially.
Yeah, I think we may switch our next session from strategies on lowering duty on other items to maybe take a look at retaliatory issues that Canada has planned, and certainly some of the products that they're looking at, from raw aluminum to aluminum products to golf clubs to things that impact Dan, like golf clubs. So, yeah.
There you go. Yeah.
So, we'll be out with that shortly in the next couple of days.
Okay. Well, thanks, everyone.
Yeah, thanks again, Dan.
Look forward to offering another session in the near future, and stay safe and be well.